What if I told you there is an ETF that has lost over 99% of its value since it launched, and people are still piling in? That ETF is SQQQ. Today we are breaking down what it actually does, why it has been a disaster for long-term holders, and why traders still use it every single day. SQQQ is the ProShares UltraPro Short QQQ ETF. It launched in February of 2010, and it is run by ProShares, one of the biggest issuers in the leveraged and inverse ETF space. The fund holds billions of dollars in assets and trades tens of millions of shares every day. Now, here is the hook. SQQQ is a triple inverse ETF. That means it is designed to deliver 3 times the opposite of the daily return of the Nasdaq 100 index. If the Nasdaq 100 drops 1% today, SQQQ aims to gain 3%. If the Nasdaq 100 rises 1%, SQQQ aims to lose 3%. It does this using swap agreements and other derivatives. The fund essentially borrows exposure to amplify the inverse return. That makes SQQQ a powerful tool for short-term traders who want to bet against big tech stocks without using options or selling short directly. Here is the catch they do not put on the front page. SQQQ resets every single day. That word daily is doing all the work. Because the leverage compounds daily, holding SQQQ for more than a few days can produce returns that are very different from negative 3 times the Nasdaq's longer-term move. In a choppy or sideways market, SQQQ bleeds value just from the math of compounding. This is called volatility decay. To see how brutal this gets, think about it this way. Imagine the Nasdaq 100 goes up 2% one day, then drops 2% the next day. The index is roughly back where it started. But SQQQ is not. It would have lost about 3.6% over those 2 days, even though the underlying index is essentially flat. Now multiply that effect over weeks, months, and years. And the long-term performance shows it. Since SQQQ launched, the Nasdaq 100 has gone up many times over. That means SQQQ, designed to do the opposite, has been crushed. The fund has had to do multiple reverse stock splits just to keep its share price visible. Hold this fund for a year while the market trends up, and you can lose almost everything. The expense ratio is also high for a passive product. SQQQ charges 0.95% per year. That is a steep, ongoing drag on top of the volatility decay. So who is SQQQ actually for? It is built for active day traders making short-term, intraday bets that the Nasdaq is going to drop. It is also used by hedgers who want to offset a tech-heavy portfolio for a short window of a day or two. It is not, under any circumstances, a buy-and-hold investment. ProShares says this themselves in the prospectus. The honest truth is this. SQQQ is one of the most misused ETFs on the market. People buy it, expecting a long-term hedge against the Nasdaq, and then they watch it grind down to almost nothing. If this video helped you understand how leveraged inverse ETFs really work, hit the like button and subscribe for more ETF breakdowns. And drop a comment below with the longest you have ever held a leveraged ETF. Let us see who has paid the volatility decay tax.